This is a bit of a test run. I'm not used to using this software, so I'm going to give it a whirl and we'll see how it turns out. This is just going to be a quick little video, and one of the things I wanted to talk about is what do you do when you lose your rhythm? We've all been in a groove where there's not a day you can do anything wrong and everything goes right. And then there's a day where you got a mixed bag, a little bit of success and a little bit of failure, and you can usually deal with that. But what do you do when things go completely and totally sideways? And it doesn't matter what you do, you couldn't trip over a winning trade. And don't say it's never happened to you because it has. Excuse me, it's happened to all of us, including myself. And sometimes it happens a little more frequently than I like. But what do I do when that happens? Is I go back to one of the more simple, basic trading methodologies that I know of, and it gets me back into the rhythm that I need to be successful. And I consider myself to be a trend trader, and I think that's why when we talk about this, it's a very simple strategy using Heikin Ashi candles. And Heikin Ashi candles, as you can see, typically trend in one color, red or green, up or down. They take a lot of the noise out of your chart. And when I say noise, what I'm talking about is this kind of chatter, right? That's the noise I'm talking about. And what the Heikin Ashis do is they smooth that out. And they do that by looking back a day to determine how the current day's candle gets formed or the current period's candle gets formed. And what I have on this chart right now is quite simple. So the solid white line is the 5 period moving average. These are simple, it's a simple moving average. The green is the 20, the light blue is the 50, and the red is the 200. These are basic moving averages that I use on a consistent basis. The thin blue line that you see underneath there is the T line. And the T line, for those of you that aren't familiar with it, is simply the 8-day EMA. That's the T line. And the dots are parabolic SARs, stop and reverses. And here's how you use this trading methodology. If we're going to use the most conservative method, you would only take longs above the 200 and only take shorts below the 200. And the 200 is this red line here. That's the 200 MA. I don't always adhere to that. It's up to you, but that's the original methodology, and I'm sure not everybody follows it. But what it helps you with, and I think this is where people lose their rhythm when they're trading, is trying to determine proper entries and exits. If you're trading off short time frames, entries and exits are everything, so you got to make sure you nail them. And this will really help. And here's how it works. What you're looking for as far as an entry candle is concerned, so let me blow this up a little bit, is you want, in this case we want to go long. So we're looking for a solid green candle with no lower wick. This candle does not have a lower wick, so it qualifies. Next, it has a parabolic beneath price. So this is your entry candle right here because it doesn't have a wick and it's solid. These guys don't qualify for obvious reasons. They have lower wicks and they don't have a parabolic beneath them. And you stay in this trade as long as you have parabolic support. Now there's other things going on here. One of the things I like to use the 5MA for, which is the white line, is that when price is trending higher, it will stay on the north side of that 5MA, like it is here. Doesn't break here, gets support at the 50, and off it goes again. Right? You could stay on this trade up until this point here, if you wanted to. When do you go short? Same thing in reverse. Parabolic, above the candle, in this case no upper wick, and that's what it has. This is probably a better example of a nicer run. This would have been your entry candle. Would I have waited to that candle? In quite all honesty, probably not. I probably would have been in here because you're failing the 50, the 20, and pretty much everything else, which is the sign of a downward move. And look what happens. The 5MA gets over top of these candles, pushes price down. Excuse me, this looks like it could be a reversal candle because it'll usually be a doji of some sort. And here you go. You would stay in your trade. Now, stays below the 5, so you're trending down. The T line stays below that as well, so you're trending down. On the way up, what am I looking for as a target? The 20 and then the 50. Real simple stuff, guys. What happens when you fail one major moving average? You're attracted to the next one like a magnet. Fail the 20 and the 5 in this case. Attracted to the 50 like a magnet. Because it's the first attempt, you bounce. That will happen more often than not. But the first attempt on the way up will also bounce. In this case, fails. And here we go. All the way back down to the 200, where we find a little bit of support. This should get some support and possibly bounce up here as a result. But the bottom line is, take shorts when you've got a parabolic above price with no upper wick. Take longs with a parabolic beneath price with no upper wick. As long as you're trading on the north side of the 5, as long as you're long, you're okay. If you're short, you're trading below the 5 like this. This looks like it's going to be a reversal candle. So just wanted to give this a whirl. Hopefully this little methodology works. If you guys want to talk about it, just let me know and we can talk about it in the chat. Take care.